Well, ladies and gentlemen, I've got a couple of quotes here to get us started. And whilst you're reading those, I'd like to just take the time to thank AJ Bell for the invitation to come here today. If for nothing else, I actually get to come to the office. And for all of you for listening to this Scottish Mortgage presentation. My name is Stewart Heggie, and I'm an investment specialist alongside the joint managers, James Anderson and Tom Slater. Now, to those quotes you've just read, they were placed quite deliberately to serve as a mental chicane. Now, the first is by the father of value investing, Ben Graham, and appeared in his 1949 publication, The Intelligent Investor. And the second quote comes from Einstein. And he made this observation following the solar eclipse in 1919 that really validated his theory of general relativity. Now, the point of all of this is to position Scottish Mortgage. We are much more philosophically aligned to Einstein's power of imagination, where it's far more to focus on what might happen rather than Graham's world, where anticipated growth is regarded as being somehow risky or dangerous. And today we're in the webinar today, the topic is growth. So what do we mean by growth? Well, put simply, it's the inherently optimistic belief that society will achieve more tomorrow than it does today. And at Scottish Mortgage, we are growth investors and we are optimistic, and we invest in transformational growth companies that address big opportunities and possess a competitive advantage that could play out over many years. And what I'd really like to share with you today is how important it is to be optimistic when searching for these growth companies, the role that private companies can play in delivering growth, and where we think we might find some growth for the decade ahead, which is really the time frame that we're thinking about. And first of all, we think very carefully about this chart, which is perhaps the most overlooked one in the world of equity investing. I'm sorry, I'm looking over this way. I've got a screen with the chart here. And this chart is based on the work of a Swedish professor called Henrik Bessenbinder. And the reason it's so important is that it shows that a very small number of big winners drive all of the equity market returns. So this data set is from 1990 to 2018, and it includes all global listed stocks. So that's 61,100 companies. And when you rank them by return, you see that 61% of firms destroyed value. It took 38% of firms to offset this value destruction. And then it was just 1.3% or 811 companies that drove the entire $45 trillion of net value creation over that period. And we believe that that is hugely important. And in fact, that pattern holds true over the last 90 years or so. So as growth investors, we try to give ourselves the best possible chance of finding those outliers and those companies producing the outsized returns. Well, how do we do it? Well, first of all, we spend a lot of time thinking about what can go right over the long term, rather than doing the easy bit, which is talking about what can go wrong. So the image that you can hopefully now see in front of you shows the absolute performance of the stocks in our portfolio over the last 10 years. And just working from the left-hand side to explain what we have here, it goes from minus 100. So that's minus 100%. That's losing all of the capital that you've invested. And it goes all the way up to 2,400. So that would be making 25 times the amount of money that you've invested. And what is hopefully apparent from this image is the importance of the extreme payoffs that a small number of stocks provide. And these are largely shown in the box in the top left-hand side. And the key to accessing those outliers is being long-term. We currently live in a world where the average holding period of a stock in a fund is less than 2 years. And at Scottish Mortgage, we have an investment horizon of over 5 years. And in many cases, we hold companies well beyond that. And indeed, 2/3 of the portfolio has been held for 5 years or more. And I think it's important to say that the managers view the mistake of missing out on one of these big winners is much more serious than making the mistake of buying a few stocks that go wrong and go down. So what we're really thinking about here are probability adjusted payoffs. Or in simple terms, if there's, say, a 25% chance of a stock going up 20-fold, but a 75% chance of a stock going down to zero, they would buy it every single time. So this approach is really the antithesis of the Ben Graham approach. So rather than building models based on existing revenue streams, we are thinking long-term, we're thinking about blue skies and where a company might get to over the next decade. But when thinking over those time periods and trying to embrace these extreme returns, we view volatility not as a risk, but as an opportunity. And that's really because no stock goes up in a straight line. In fact, some of the stocks in the portfolio have made us look quite silly on occasion, in fact. So the chart that you can now see here are those top 10 stocks over the last decade, and it's the maximum drawdown that we've experienced in a 12-month period. And what becomes immediately apparent is that many of them have fallen by over a third, and some of them by more than 50%. And our largest stock in the portfolio today is Tesla, and it features on the left-hand side. Now, this is a company that we first bought in January 2013, and almost immediately after that, it fell by 40% in value. And in fact, it's fallen by over 30% in value on more than 10 occasions since we bought it. So it's been one of our best performers, but it's also been one of the most volatile. So the test during these times is really just about turning off the Bloomberg screens, ignore the short-term news flow, and just focus on the long-term prospects of a company. And to do that, you really have to endure. And in the example of Tesla, that has not been an easy company to own. It has a colorful founder who's attracted the wrong sorts of headlines. It's experienced a number of operational setbacks, and put simply, a number of people wanted it to fail. The oil lobbyists couldn't be described as being fans, and indeed the big automakers didn't like it very much either. Now, putting Tesla to one side, you can see a number of established names on this list. So Amazon, Alibaba, Workday, Tencent, these are big established companies, and they are benefiting from increased returns at scale. So the opportunity that lies ahead of them remains tremendously exciting. But we as growth investors, to paraphrase Jeff Bezos, have to live in the future. And that means seeking out the next Amazon, the next Alibaba. And the good news is that we have a really strong pipeline of new ideas coming through. But one thing that we have to accept is that the world is changing. And the main change that's taking place for us as investors is that companies are staying private for longer. And this really shows up in the data. So there are now half the number of public companies that there were some 25 years ago. And the reasons for that are really, for that shift are really quite fundamental. The simple fact is that online business models mean that companies can grow more rapidly, but with the requirement for much less outside capital. So an easy way to think about it is that you used to have to build bricks and mortar stores, hire sales force, to sell your goods, but now you can rent a store space on Shopify, you can do your advertising on Instagram or Spotify, and you can do all of this by renting server space on AWS. In fact, you sitting in your living room at home could build a business right now. And the effect of all of this is that more returns are being created before companies go public. And this can really be seen in the chart here. So if we just take the top company, that's Amazon, it was founded in 1994. 3 years later, it listed on a valuation of $400 million. But if we look down the list to, say, Spotify, founded in 2006, listed 12 years later on a valuation of $27 billion. Now, public markets are not dead, not by any means, but a growing number of business leaders, certainly the founders that we're talking to, are no longer in an anxious rush to get there. And part of the reason for that is that they have far more freedom when they're private to concentrate on the task at hand in trying to grow out their business. Now, our approach, many people would think that we take a different approach to investing in private companies, but in fact, it's no different to investing in public companies. Some mistakenly believe that because these companies are private, they're somehow smaller or more risky. But just to be clear, we're not angel investors. nor are we venture capitalists who are getting involved in, in the operational goings on of a business. We are investing in established private companies, many of which are larger than some of the public companies that we own. So the largest would be Ant Group in China, which is now the biggest fintech company in the world. If it was placed in the FTSE 100, it would be the largest company. We have a number of other private companies that are worth over $20 billion, which would place them in the top 30 of the FTSE 100. And what this means, and what we're really gaining from these companies, is we're gaining access to returns for our shareholders that we could not access if we're investing only in public companies. So Alibaba was the first private company that we invested in that then went public. Then there have been a number of other examples such as Spotify, Meituan, Jiangping. These are all large established businesses. But in all three of those cases, they had more than tripled by the time they reached IPO. So another thing that's been taking place in our investing in private companies is that we've been learning. And one of the things that we've learned is that we're building stronger relationships with companies. And we believe that's because our timeframes are aligned to the founders. So they're engaging with us on long-term strategic issues. And one of the things that's been enormously beneficial is that once they turn into public companies, we still have access to the management, so we can access the growth for our shareholders. Now, the next image shows you that a pathway is emerging within the Scottish Mortgage portfolio, where the companies that we first bought when they were private are now being held through IPO, and we hold them over the long term. So to just explain what we have here, the blue line shows the percentage of the portfolio that is invested in private companies. And at the end of September, it was 17%. But the yellow line then includes all of the companies that were first bought when private, some of which are public. So there's an additional 19%, and that makes up the total to 36%. So we've seen the impact that a small number of companies can have on the portfolio, and that by casting the net into private markets, we're capturing more growth for our shareholders. But where might we find growth over the next decade, which is really the time frame that we think about? Well, one point that's really, really important is where we get our inputs from. And the managers talk enthusiastically about trying to be the dumbest people in the room. And the easiest place to do that is by spending time with academics who are thinking about the future. And one of those is Professor Carlota Perez of the University of Sussex. And she studies paradigm shifts and has looked at over time the long-term impact of technological revolutions. And we're going through one at present. Now, this is not just COVID related, it actually dates well before that. And it can really be characterized by companies using the tools of modern technology to create new business models that make the incumbent bulk production world basically obsolete. And that can extend out in a number of different ways. So, for example, the entire food chain is currently being redesigned. So the image that you see here is of two delivery hero agents. There has been an explosion in food delivery around the world. Now, Delivery Hero is a really interesting company. It's a German business that unusually chose to exit its home market because they didn't see themselves reaching dominance there. And then since then, it's become the largest global food network outside of China. It has a leading position in about 50 countries worldwide, and it's also having the ability to move into adjacent markets such as what we would call quick commerce. It's the rapid delivery of groceries and essentials. Now, the next example I'd use is that I suppose there's a changing work environment. So you can see from the speakers today that some of us are sitting at home and some of us are in the office. Now, large of that is COVID related, and we don't know what's going to happen post the pandemic. But the idea of lots of people being in the same building actually came about from the Industrial Revolution, where lots of people were required to man machines. But we nowadays have a knowledge-based economy where and companies want to attract the best talent, but people want to have a larger say in where they work, when they work. So companies like Zoom facilitate this. One thing that we have found recently in engaging with our investee companies, there are chief executives who we would contact and then hope to get a meeting within, a fortnight, a month, And actually, the answer's just been coming back. Give me 20 minutes, I'll get a coffee, and then I'll be on Zoom. Things are changing. Now, Matthew mentioned healthcare earlier. We also think that healthcare is really important, and better healthcare, and we're seeing huge opportunities in this space. And we see it largely where data meets healthcare. So the example given here is Illumina. So it's a leader in DNA sequencing. Now, 20 years ago, it took billions of dollars and a couple of years to map one human genome. Now the cost of mapping a genome is a few $100, and indeed the COVID-19 virus was mapped in a small number of weeks. And because of that, vaccines have now been created and are now being distributed. So this matters a great deal, not only for us as growth investors, but in fact for human society at large. In the interest of time, I'll click on to the next one, and it's really, this is China. China, we feel, is misunderstood, and for us as growth investors, it simply cannot be ignored. Many people see China as being the factory of the world, or government controlled, or being somehow restrained by the US government. But when people make broad generalizations like this, they really do miss out on big opportunities. If you think about the United States, there are 10 cities in the United States with a population in excess of 1 million. There are over 100 of those in China. And what is so exciting is that the consumer consumption story has barely even got started there. So if we think about consumer consumption as a share of GDP, in the US, it's approximately 70%. In India, it's about 60. In China, it's only 40. And that's come up from 30 in the last decade. So what we are seeing and who we are meeting are companies that are growing up in a ferociously competitive environment, and they're addressing an enormous market where the rewards are simply huge. So to give you an example, Meituan Dianping, down at the bottom there. Now, this is a company that we first invested in when it was private. It has grown tenfold since then, and we recently added to our holding. And that's because we believe that their opportunity has got larger and their competitive advantage has strengthened. They are, again, an online delivery platform, and indeed were an essential lifeline during the pandemic. And to just give you some idea of scale here, Grubhub in the United States is the largest delivery platform there, and it delivers about 500,000 meals a day. Meituan Dianping delivers approximately 30 million meals a day, and it's increasing. Then on the supply side, higher grade restaurants are choosing to have their meals delivered. Then in terms of the competitive environment, Alibaba's Ele.me is the #2 player in the market, and it's just conceded that position. And you have to understand what's going on in China. There are now homes being built there without kitchens. And in the interest of time, I'll click on to the next one. And it's interesting that Matthew has brought this up already. So Scottish Mortgage first started in 1909, and it might actually have been one of these people on this vehicle that were our first investors. Fossil fuels have helped create a huge expansion over the last century, but we believe that those days are coming to an end, and it's because of perfectly predictable long-term trends taking place. The cost of producing solar energy is reducing by about 20% a year. The cost of battery storage is reducing by about 16% a year. And alongside that, we have Moore's Law taking place, the continuing doubling of computing power. So essentially, within the next decade, it's becoming increasingly likely that the majority of the energy that we use will be renewable, which I think came up in Matthew's chart, but they could cost next to nothing. And that provides us with almost endless investment opportunities, because new business models are going to be popping up all over the place, possibly some that we cannot even conceive yet. Now, these long-term transitions and trends can be quite hard for us to wrap our heads around. And I always think of an excellent quote by Bill Gates on this, who said that most people overestimate what they can do in 1 year, but underestimate what they can do in 10. Now, regarding this energy transition, the main investments that we've made have been focused on electric vehicles, such as NIO in China, or Tesla, or Aurora, which is focused on autonomous driving. But we have been branching out into other areas more recently, particularly private companies, and one of those is Northvolt. Now, this is a Swedish battery manufacturer, And it comes from a very favorable starting point. First of all, they've got the ex-CFO of Tesla coming in, so commercially minded people. They've had a number of coders coming over from South Korea who can help them. And in addition to that, they have a team of top battery chemists, but they also have a key cost advantage because their first plant is actually based near cheap hydropower in Swedish Lapland. And they've already got orders from lots of the top vehicle manufacturers, or commitments from the large vehicle manufacturers for their batteries. Now, the last point that I would just like to finish off on Scottish Mortgage is that we think we are genuinely different. We're resolutely optimistic in our approach, and we provide our shareholders with a unique access to both public and private companies. But the final point is that we believe that costs matter a great deal because they have a considerable impact on compounding of returns. So we choose to share the benefits of our scale with our shareholders, and the ongoing charges are 36 basis points. That's all from me, and Roland, I think I came in under time.